Well, let's discuss the earnings of five-star business finance with the management. Mr. Lakshmipathy Deenadayalan, the CMD, is joining us on the show. The stock has been having a stellar run since its listing last year. I remember it listing sub the 500 rupee mark around November, December, and since then it's gained ground and it's currently trading at 730. So a solid gain of almost 45-50% happening as far as the stock price is concerned. And that's because the earnings have been strong as well. And in fact, this quarter the management has gone ahead and increased the growth guidance from 30 to 35%. Mr. Deenadayalan, what's giving you this confidence that you can grow at 35%, and will it be any worry at all on the asset quality?
Yeah, thank you for this. The background of revising the growth guidance from 30 to 35% has come from, if you see last 5 quarters momentum, what we are seeing at the ground level, both at the sourcing and the disbursement level, it has gone up substantially. And wherever we open our branches, last year we opened 75 branches. All these branches have been break-even in 6 to 9 months. So this clearly shows a very strong indication at the ground level that the need of credit for the unlent segment where Five Star is targeting is abundant and keeps growing. I think keeping these in mind and our strong execution, what I said in last 4-5 quarters, we have revised our guidance from 30 to 35%. And with this revision, I don't think there will be any impact on asset quality, as we have been constantly saying we are a collection first business model that takes care of our careful underwriting, and the collection model that what we have been put at the ground is resulting a very good quality on quarter. If you compare last quarter with June quarter, across all buckets, we have improved. So I don't think there will be any concern on asset quality revising this guidance.
Your ROA, it's something when I speak to folks who track the lending business, who've been in the lending business for 20, 25 years, they're saying that it's too high to sustain for a longer period of time as you grow. That's a very fair assessment, right? As the base will grow, this kind of an ROA will not sustain. How would you defend that?
Nikunj, is a right question. People ask me many times. I think I'll use some time to explain this. I think a lender growth derails from two concepts, according to me. One, if the asset quality shows up the ugly face. Second, if your product is being copied or replicated easily. What has happened to the gold loans and other products of this country? If you see the underwriting of Five Star and the collection model, what we have been set up, it's giving results for last 2 decades. And our worst asset quality, even during the worst of its COVID, was 1.67%, which is one among the best in the lenders to the profile of customers whom we deal with. So I don't think asset quality will derail in Five Star. So that ensures our growth momentum is here to continue. Second, from a competitive edge perspective, Nikunj, I don't see anyone getting into this sector and easily just copying what Five Star is doing. It took 10 years for us to learn and master this underwriting, sourcing, and collections model. So it is not so easy like other product lending, like two-wheelers, vehicles, or gold. It is not easy to get into this small business loans, especially in 3 lakh to 5 lakh ticket size. So both put together, I don't agree that people said to this when I was 100 crores, people said to this when I was 1,000 crores, people are saying again when I am 7,500 crores. Obviously, I can only do and show this.
Now, you are in the category which is the sub 10 lakh category. That's the large dominant area for you. Parallel to that is that if I look at the numbers of the microfinance sector and banks, some of your peers, without getting into specific of banks now, that sector has seen a lot of volatility. The rural demand is under pressure, but there is no NPA problem. If I put 2 and 2 together, which is the real shape of the economy, what peers are doing versus your performance, there is a difference. It's a commendable difference. I'm not criticizing it, but I'm curious.
Nikunj, I don't comment on others and I don't comment on other products. I can only comment on the strength and the capability of the product what Five Star has developed on his own experience for last 20 years. So I think first fundamental difference is I don't agree that semi-urban and rural market is falling down, especially if I'm comparing with COVID-2's impact. They have come a long way in very positivity. I think our customers' cash flow is getting stronger and stronger. That's been reflected in our collection efficiency. Second, I think the choice of your customer, that is more important. The intent and the ability. Intent comes first in 5-star. The ability comes second, and third comes the collateral. If you are able to marry this intent, ability, and collateral with the family whom you're going to lend, I think you generally don't do mistakes. That's where happened to 5-star, and it's been shown to the private market for last 2 decades and public market for last 4 quarters.
There are 2 large P investors in your company, Sequoia and TPG. When you speak to them, are they committed to the business? Because again, I'm asking this question purely, let's say, to address our viewers. And sometimes the concern is that, okay, the company is doing great, but guess what? There are 2 P investors who came at a much lower rate. And now if they start selling, there could be an indefinite supply because this share will hit the market. This is not a QIP or OFS where money goes back into the company.
Yes, Nikunj, they will support the company. I think they're great believers of lending to this unlent segment in a very precise way. But having said that, yes, like how we borrow our debt, they also borrow from the LPs, which has to be returned at a given point of time. And that is why if you see our IPO was full of offer for sale. So we have given enough liquidity to our existing investors, and we keep doing that. But we have taken a very clear call that whatever the liquidity that our existing investors wants, it will be routed and done by the company in a very guided way. So I don't think you have any disruption in the value that got created.
Last question from my side. Your net interest margins slipped a bit, at least on a quarter-on-quarter basis. And I think you had earlier hinted that net interest margins are not sustainable around the 18% level. Where do you see it stabilizing?
Yeah, you're right. We never guided at this level. Our guidance always was around 14 to 15% was the sustainable NIMs for a longer period of time. There was nothing that got reduced. See, as you keep increasing your debt in your balance sheet, you have to pay your interest more comparing to the last quarter. So if you see the leverage of 5-star is moved from 1.5 times to 2 times now. This will keep moving in next 3 years. So your NIM will automatically get compressed. It is no other way. But what you should see is how is our ROE performing because of leverage. If you see the ROE, it is now all-time high at 16.5%. That will move towards 20% plus in next 3 years. That's the game plan, which I have explained in your channel long back. See, I think as the growth picks in, the leverage has to kick in. So we are at very low leverage. As we increase the leverage, there will be the compression in NIMs indirectly.
About a CAGR growth of 35%, and if I use a rule of 72 for the benefit of our viewers, 72 divided by 35, the book doubles in less than 2 years, about 2 years, right? And you've grown in the past by raising equity. But this time, will you not be raising equity? Will you grow on your current balance sheet?
Yeah, Nikunj, that is a mathematical output. I leave it to you on doubling the company in whatever years you said. Yes, 35% is a very strong commitment that we are giving to the market. Always 5-star speaks less and delivers more. So I don't think there will be any doubt on delivering 35%. Same thing when you asked at 30% of one of the research report, I said same optimism note. There is no doubt in raising our guidance. But as you rightly said, the 5-star was a standalone NBFC, so we need the capital at the initial phase of growth. Now, if you see our AUM is around $1 billion, and we have close to 50 relationships with banks and NBFCs to lend to 5-star, and they are lending at a very attractive rate. If you see the June quarter, the incremental borrowing cost is at 9.18%. all-in cost is 9.5%, and the book cost is 9.8%. So technically, there is still a little bit of room available in the book where you see the borrowing costs coming down. Keeping this point in mind, I don't see raising debt for next 3 years will be any kind of concern. So as I said, the leverage is going to be the game plan for Five Star. I think we have put all best foundations and relationships which are available in our country to take up to the next level in next 3 years. So I don't think we'll be coming to the market at least for next 5 years.
5 years. So I'm just going to wrap it up and correct me if my interpretation is wrong. What you're saying is that you'll grow at 35%. 30s become 35. You leverage your balance sheet. If you're leveraging your balance sheet, obviously return ratios will change. But importantly, you will not come to equity market for next 5 years. And you will manage from your current balance sheet.
Yes, of course.
And there is no NPA problem.
Yeah, I think the NPA doesn't, whether you raise capital or debt, as long as your underwriting is right, that comes from your own experience, I don't think there will be any issue in the quality of assets what we build in.
Stress that point further, what Nikunj was asking about the large investors which are there on the books. You haven't heard anything from either Sequoia or TPG that they're looking at, maybe cashing out something over the next at least 3 to 6 months?
See, I can't comment on that right now, but what I can say is we have given enough liquidity in our IPO, which was a full offer for sale. And second is, if any liquidity is need of it will be managed and it will be done in a very clear way. So that will not have any impact on our value.
On that note, we let you go. Appreciate you joining us on the show and talking to us about the outlook.